Like AI has just changed the game. We are in the midst of some fundamental changes in AI. Outbound is about to die completely. So when I was running Kanopy, like outbound email was a fantastic way to drive lead generation. In the next 3 to 6 months, I think it's going to be dead. We are in the midst of a huge generational shift. The generation coming up, Gen Z, is now like 50% of the consumer and below. And so it's just like they don't use the same go-to-market methods that you and I used when we were growing up. It's a new mode of reaching the customer. Like one other area that we're really interested right now is just like vertical SaaS. And the reason for that is just like, hey, like you can just like leverage models. And then if you can build really, really deeply into these verticals, like whether it's like lawyers or marketing agencies or doctors' clinics or whatever, like build product which makes you go really, really, really deep into those customers so that you're embedded in their workflows. I'd say with founders, like I loved is just like when they're able to reflect as much on the negatives as the positives. Like I think, sometimes you have founders that come in and it's just like all roses and it's just like, hey, like this is going great and this is good and look at this and this and this. And it's just like, yeah, walk me through like what's going wrong, what mistakes have happened. Like, and I think the best founders can talk about the successes as much as they can reflect on the failures.
Tom, thanks so much for joining us. Really excited about this episode, mainly because of the awesome content that you share so freely with the ecosystem that I know has helped many, many founders and investors. So thanks for spending the time.
Oh, thanks for having me. I really appreciate the feedback.
How did you end up in this game? Because almost no one we talked to went to school and said, I want to be a venture capitalist.
Yeah, I'm probably revealing my age, but I don't think there was a venture capital ecosystem in Australia when I was coming out of school. But yeah, look, I came out of school, did a couple of years in consulting. I think you talk about sliding door moments in the career, and I think there was this sliding door moment which happened when I was in consulting, where I actually took they won a project which was to go out to the Pilbara to work on a mine site for a year, and they're like, who wants to do it? And everyone's hands stayed down, and I was like, you know what, that sounds like an adventure. So I was out there living in a shipping container for a year in the middle of the desert. It was like 55 degrees in summer every day. And that was a sliding door moment for me. It was just like, I just loved this kind of transition out of the boardrooms and offices and suits and ties of kind of the classic kind of consulting role, and out there in steel cap boots, just like operational, getting stuff done. I just loved it. And so I actually came back from that experience and was just like, there's got to be something out there which is more like this operational side of things. And so that was the moment I jumped out into a startup. So this was 2010, and it was a startup called Our Deal. It was like a group one for Australia, like group deal buying online. This was like hot at the time. Google had offered to buy group one for $6 billion. It's now trading for 150 mil. So that was a bad decision to walk away from in retrospect. But yeah, so it was a friend of a friend, and started off, it was up in Bondi Junction in Sydney. There was like 8 people just in a garage, and I joined in some ill-defined role. I think it was like head of commercial insights, and it was just like, just do whatever we need to do to get done to build this business. And long and short of it, it was just like this awesome journey. 10 months later, we were suddenly doing millions and millions of revenue. I had a $3 million marketing budget that I was managing. We were 80 people, and we sold to News Corp and Channel 10. And this all happened in 10 months. It was just like this wild, high growth, successful journey. And so I came out of that and I was just like, oh my gosh, this is amazing. How do I do that again? And looked around, and there's nothing in Australia. There was no ecosystem here. And so, yeah, at that point, my sister actually was working on something over in Perth, and she had this kind of company. It was called Kanopy. It was like a DVD distributor. And I was like chipping away on the side with her to kind of like pivot the business into streaming, just like Netflix had done. So transitioned over to San Francisco with her. I joined her on the business, and we basically started building this product. And the way to think about it was like, think of Netflix, like a website, lots of films, a bit more documentary and classic cinema types content. And rather than selling it to people like Netflix does, we would sell it to universities and public libraries, who would then make it available to their constituents. And so spent 6-7 years in San Francisco building that company up, bootstrapped for a while. And that was a successful outcome, got it to a good place, sold it to KKR, a big private equity fund. And this was the kind of sliding door moment that kind of got me into VC, which was like, came out of that and I was like, I had 6 months of kumbaya, like, what am I going to do next? Who am I? Staring into the tea leaves. And I just had this like interesting thesis. I got connected to a couple of VCs around that point in time. I was actually living in Denver, Colorado randomly. And yeah, I had this thesis, which was just like, look, I've learned that I love these startups. I've done 2 of them. I really love it. And I actually loved working on both of them. And maybe VC is a way to work on many different startups at once and still have that like little bit of operational element, but spreading it across 10 startups rather than just one at a time. So that was the thesis, connected with the fund there and got involved with a fund called Access Ventures and now Blackbird. So that's been about 5.5 years of venture capital now.
When did you move back to Australia? Like what era was that?
So that was the start of 2021, COVID era. Had to do quarantine in the hotel with a 3-year-old and a 1-year-old, which was not fun. It was an interesting time. Like I think it really shook me. I left Australia in 2011 and that was an interesting ecosystem. As I mentioned, not much here. I think there was probably like sub $100 million of venture capital invested in the ecosystem. There was no Canva at all. And Atlassian was just in a garage somewhere. So there wasn't really much of an ecosystem. And then coming back in 2021 and suddenly you got an ecosystem where there's $5-10 billion of capital and lots of VC funds that we know today and all of these kind of stallions of tech. So it was really interesting to come back and just see what had happened in those 10 years.
What was that perspective of the Australian market? So coming back in 21, I appreciate you were locked in COVID, but particularly coming out of Denver and the US.
Yeah, like it was exciting to come back. I think at the root of it, I don't know about you guys, but I'm pretty patriotic. And so I think like I was excited to come back and get my teeth into the ecosystem here. And I'm excited to just this idea of like, not just investing to make returns, but investing to build an ecosystem in the country and make Australia stronger in the world. I'm pretty passionate about that. So I was really excited. And like, I think like as much as we talk about the positives of Australia, like, wow, look how far we've come and we've got all these companies and so much more VC dollars. And this is really exciting. There's 1 million people in the technology sector in Australia now employed, which is all awesome. But at the same time, like we're a bit of a peanut in the scheme of things. Like I came from Denver. When I moved from Denver to like Colorado was a bigger startup ecosystem than the whole of Australia. Like at the time I came back. So you're talking about like the 10th biggest state in the US is bigger than Australia. So yes, we've come a long way, but I'm also like really excited for where we can go. And I think the journey ahead is much more exciting than necessarily just reflecting on the journey that's passed.
So with the operational experience that you had before becoming into the VC ecosystem, is that critical to the pattern recognition that often VCs need to have that experience, or are there some drawbacks that come from it because there are some inherent biases based on your previous experience? What's your view on that operational experience and picking the right deals?
I think it's both. I think like the starting point I say is like, you don't need operating experience to be good in venture capital. Like I can point to 100 of the best investors in the US who had no operating experience and are fantastic investors. And all the best investors come from all different walks of life and backgrounds. So I think this idea that operating experience connected to being a great investor, like it can definitely help in certain ways, but it's not a prerequisite. I think there's pros and cons. I'd say like the pros are like the ability to dive in with founders on certain topical areas where others may not have as much experience. Like we obviously talk about go-to-market and some of the writings I've done on that. Like it's not just something I've spent a lot of years working on, but it's something I'm really passionate about. And so typically when I'm working with founders, I'm going really deep on that and doing workshops with the full team. I'm often meeting with the VPs of sales and the go-to-market teams as much as I'm meeting with the founders of portfolio companies. So that's the positive. I think like on the negative, like you have to learn some things. Like one thing I really struggled with when I made the transition was when you're an operator, you're like in the pilot seat and you're driving the plane and you're like getting your hands dirty. And when you're in a VC, you got to pull out of that a little bit and you got to accept the fact that this is the founder's company and they're doing the operations, and you can't go too deep, because if you go too deep, then you're not doing your job, and you've got like 10 of these you've got to help, and you've got to keep looking for the next deal as well. And so it's this element of like, you got to do the best job you can at supporting them on the operational matters without going too deep. And also just like this element of accepting and letting go. Like sometimes things will fail. And I think if you're in the startup, you're just chugging away to try to make it work. And I think like in VC, there's this natural element that you invest in 10 companies and some of them will fail, and you just got to accept that failure. I think the other kind of thing I had to unlearn as well, the Kanopy company that I mentioned before, we actually bootstrapped that. It wasn't a VC-backed company. We did get growth capital from more kind of private equity fund, but we were cash flow positive from day one. And we had to be because we didn't raise any money. And so it was kind of like this very conservative mentality where we were looking at the bank account every week, making sure that we could run payroll, and then we would like get customers to pay up front if we could, and they'd pay up front. And when they paid up front, we would then go and hire someone, and we look at the bank account and say, oh, we've got like an extra 100K there, let's go hire someone. And we just very conservative iterative growth. And as the VC mentality is typically kind of like, go, throw fuel on the fire, let's get this thing and get to A round and then raise a lot more capital, and then off you go. And it's just like a different journey. And that was one thing I've had to unlearn as well. Because I think when I first got in, I was just like, whoa, like you're raising a $5 million round, like hold up, like slow the horses, like why don't you just like raise 1 million? And like, why are you spending all this capital? Like, where's the cash? And I think that can, obviously we care about profitability and unit economics, but at some point when you're onto something and you're investing for growth, and that's like the VC model. And so that's been something I've had to unlearn and learn.
But on that last point, I think our experience has been in the last few years, like not the last 18 months, but in that COVID boom, some founders raised too much money too soon, and some of their decision-making didn't optimize some of that capital. So when it ran out and they didn't have some of the traction, they had no experience on actually being able to flick the switch the other way.
Yeah, I think that's right. I think it's probably two things. I think one thing which happened was founders were on a trajectory which kind of dropped away from them. So you had all these founders who were like, oh, I'm going to raise my Series B in 6 months, and these are the milestones I got to hit, and then I'm going to get there. And then suddenly the goalpost moved, and it was like, okay, that Series B in 6 months, it's not going to happen. And if you want to get it done, the goalposts are now up here, not down here. And so I think that kind of like sudden, like, oh, I'm actually not going to fundraise probably for the next year or two, like just throw everyone's like cash planning out the window. But the other thing which happened was, as you're kind of touching upon, like a mentality shift. I think we went from this mentality of grow at all costs. And it's not just like in VC, you saw that in the public markets. And to be honest, like venture capital is like a reflection of the public markets and other investment markets. We saw that in real estate too. Like it was just real estate prices just went ridiculous. But yeah, so it was like, it went from this mentality of just grow at all costs, and there wasn't much attention necessarily paid to unit economics or profitability. And then that's kind of like swung the other way. But I'd say like growth is still the number one priority. Even if you look in public markets, you look at correlation rates between like enterprise value and versus growth versus profitability. It's growth is still like far outweighs the number one priority for any business in venture and in tech stocks. But now profitability is like back on as like, hey, let's grow, but just make sure you're doing it efficiently. So
yeah, and growing in a healthy way, not just growth like a cancer. But just picking up on that, so healthy growth, and you've written a lot about go-to-market strategy, go-to-market funnels. I'm really keen to unpack that because we do use your content there a lot with different founders. But what do you see founders getting wrong? What's the most common mistakes that founders make in terms of healthy growth?
Yeah, and it's a really good question. I'd say it depends by stage, but I'm going to just assume like at the early stages, the things that I see founders getting most wrong around this is just the number one thing I'd say is like trying to offload sales. And especially if you've got a founder where sales might not be in their DNA, like they're a technical founder or a product founder, it is really, really hard to find product market fit when you outsource the customer side of things. And so you might have some founders who kind of like try to bring in a VP of sales or a director of sales like super early in the process after they've got their first customer. And then they just go, okay, like I'm going to now focus on product and hey, go get me all these customers. And it's just like, that's a really, really dangerous thing to do. In the early stages, as you're finding product market fit, like there is this really tight recursive kind of loop between customer feedback and product information and customer feedback. And you need to, before you need to kind of like find your go-to-market fit too, before you start like really throwing fuel on it. So I think like there's this element of like just working with founders to get them comfortable with, hey, like pick up a phone, cold call a customer, cold email a customer. Like that doesn't come naturally to everyone. And sitting in the customer, doing a customer pitch doesn't necessarily come natural. And so like a lot of that is that can go wrong and that I focus on in some situations. So the other thing is like constantly experimenting. I think it's like at this early stages about having hypotheses around what might be the right sales approach, but you need to experiment around that and constantly iterate. And I think like the danger is like you build assumptions around what the right approach might be just based on your first customer. Like a lot of the time you get these, especially like enterprise customers. You might have a early stage company land like an enterprise customer and it's a great juicy ACV and you're like, wow, okay, like let's go and get 10 more of those. And that defines our ICP. And it's just like, it actually turns out that was actually like a bit of a one-off, and that customer wasn't necessarily a reflection or indication of the market opportunity. And so you got to like actually unlearn that. And you might even want to like force churn that customer and restart and go in a different direction. And then I'd say like the other kind of thing, which we talk about like in the article, just like product-led growth. And I think the big thesis of the article is around like product-led growth is it's not just like a static state. Like, you either do Slack's freemium model and you're product-led or you're not. It's like product-led is just like a mentality. It's just like this idea of like using product to try to do the job of go-to-market rather than throwing people at the problem. And I think that that's another big thing that is often where folks make mistakes. It's just like trying to drive growth. Like, hey, I want to grow 2x, 3x this year. I'm just going to throw people at the problem rather than thinking really carefully about how can I use product to do that more effectively and solve that problem.
I mean, we often see companies start getting a little bit of traction in enterprise, then find that it's a lot harder than they thought. And so still with an enterprise product, enterprise cost structure, enterprise sales structure, I'm going to go try and do some PLG stuff where people can sign up as well. And you end up, as I say, all over Tom's map. You can't, you find me a really successful company like a Canva. They had their go-to-market in a particular vertical nailed before they started to go wider, when they had the resources and the brain space and the cash and all of that. Whereas companies that try and do all over the map too early, they just get themselves into trouble.
It's like, yeah, that's true. It's really like it's a lot easier to start with bottoms up product-led growth and then grow into enterprise. And that's where most like Canva started their like freemium, 200 million like monthly active users. And then as like in the media, like they're growing their teams and they're growing their enterprise kind of products. And that's what's going on now. That's the same journey that Zoom had, Slack had. Like it's just like bottoms up's the start, and then you layer on the enterprise motion or mid-market motions. It can be really hard to go the other way around. Like it can be really hard to start with enterprise and then try to become product-led. But again, like there's nothing wrong with being an enterprise sales company. Like there are plenty of companies that are enterprise, like Palantir IPO'd with 8 customers. And that was a really successful IPO. It's a very successful company. You don't have to be product-led in terms of like bottoms up, individual kind of marketed sales to be a successful outcome. There's nothing wrong with enterprise sales, but the idea is just like, even if you're going to be enterprise sales and you're never going to do bottoms up, it's just like, where can you use product to maybe just like improve and reduce the like cost of acquisition, or having like opportunities for upsell in the enterprise product, or using product in other ways to make that more efficient. Yeah, is often the question I'm asking.
Jack?
I was just going to ask, Tom, what other areas do you commonly feel like you're helping founders after you make an investment?
Yeah, I think like another kind of area, a big one is really around just setting up the right cadence for, what's the right word for it? I'd just say like reporting and setting goals. I think I find like, especially like these early stage founders, like you're pre-revenue, you haven't hired your team yet, you've got an idea, like you're right at the start, like you haven't really kind of like setting, okay, like I just got to set like, what are my goals for this month, this quarter, this year, and then actually like tracking against them. And so often what we're doing is just putting in place like a cadence of like, hey, okay, like let's set up a cadence of meeting up. Let's set up a cadence of reporting. Here's the monthly reporting template. Let's now sit down and ideate, like, what do we think the actual goals should be? Why do we think those should be the goals? What do we think those goals actually unlock in terms of like, maybe it's the next round, or maybe it's like the next stage of like making more hires. And I think like just, yeah, that's like a really good process, because I think that for a lot of founders, especially if they're like a solo founder or maybe we're the only investor involved, like just having that as like a sounding board and kind of like sitting down and, ideating on that is a really important process. And yeah, look, I'd say, generally speaking, I'd say like another big area that like we help out is really around like unlocking the network. And I think we pride ourselves like on the Blackbird community, and that there's like a softer element to that, just around like the community, and we're organizing events and founders helping founders. But there's also like a harder kind of process there around like we actually have like an AI kind of network navigator that we've rolled out, where it's just like, hey, like, what are you looking for? Are you looking for an expert on pricing? Okay, like let's go into our community. Like we've got this whole database CRM, like let's go search the community for anyone who's specialized in pricing, and okay, here's 4 people that you could talk to, and unlocking that. Okay, oh, you're looking for customers? Like let's define the ISP. Okay, like here's 10 people you can talk to. And I think like at the early stages, like that's the best value you can provide. It's just like, I need to talk to someone who can help me with pricing. I need to talk to customers. Like, can you help me get my first customers going? And so, yeah, that's another area. Help out a lot.
So since writing that first go-to-market article, have you Has anything changed? Has anything evolved? Anything that you've learnt, given it was a few years ago, or in reality, there's a playbook and you've just got to stick to it?
So honestly, I love that question. I would say the biggest thing which has happened since I wrote that article is AI. And it's funny you ask the question because I actually think like it throws a lot out the window, not in terms of the strategy. I think all of the strategic principles about go-to-market are completely sound. It changes all the tactics. Like AI has just changed the game. Like I talk about in the article how like major underlying kind of waves in technology, how they impact go-to-market. So we talked about like you start off with the cloud, like the cloud computing and how that kind of unlocks SaaS, like Salesforce. Then we talked about social and the mobile phones and social media and how that unlocked bottoms up PLG. Like suddenly, oh, I can reach to people on LinkedIn and Facebook. Like that unlocked bottoms up individual product-led growth. Then you have like open banking, and that kind of unlocked these like embedded fintech monetization. Like you see like MindBody is like monetized based on like payments, not really necessarily based on SaaS fees. The next thing is AI, right? Like that's the big wave. And the question becomes, well, how does that actually impact how go-to-market operates? And there's some fundamental changes. I think we are in the midst of, we're not quite realizing it yet, but we are in the midst of some fundamental changes in AI. Outbound is about to die completely. So when I was running Kanopy, like outbound email was a fantastic way to drive lead generation. In the next 3 to 6 months, I think it's going to be dead. And the reason for that is because with AI generated content, there is just this bombardment of outbound emails with like Zoom Info, Apollo, like all of these data sources. You can find everyone's email, mine included. I get bombarded by inbound, like just cold emails, and spam filters are going to go up and people are going to get tired. And it's going to be harder to cut through. So I think actually, and this is potentially going to be the same with like outbound phone as well. Like you're seeing like a lot of like outbound AI kind of calling as lead generation for mortgage brokers and real estate agents and others. So I think it's going to be really interesting. And then you've got the element of like AI content, like how does that impact things like how you can create blog posts or SEO? I think like fundamentally, if I just take a step back, and I don't have the answers here, but I'm just giving you my gut, I think that we are entering a world where it's just going to become like a much more creative a creative kind of go-to-market strategy is going to be what defines success versus failure. I think it's going to be companies that can really lean in on brand, SEO, and content, so they're less reliant on like paid marketing and outbound cold. It's going to be companies which are like leaning in on like community, like open source in developer communities. I think is like growing as a strategy for like developer tooling. But like even outside that, like People Geeks is the community kind of product for Culture Amp. Like that's been like huge in actually like their go-to-market strategy. I think like even like events, we had like Dovetail, one of our portfolio companies, they hosted this event in San Francisco like 2 months ago called Inside Out. And it's like this event for user researchers. And I think it's all of these like just being really creative with your go-to-market to get out of, okay, like outbound email and paid marketing is no longer going to work. So what do we do? And you have to actually be really creative and do some of these other things to reach and touch customers. And that's going to define like success for go-to-market moving forward.
I'm going to edit this episode as quickly as possible because it's not one of Tribe's portfolio, but in the family office I look after, there's a legacy company from about a decade ago. And I had a session with them last week and they said, oh, we've got it nailed. Have you seen these AI avatars? All we've got to do is type in the script and have a look at this. It creates a sales video. And so what we're going to do is on LinkedIn, we're going to have this. And it's like, hi, I'm Steve. And I was like, oh, fuck. And then, but what was interesting on the call, not wanting to be too rude about it, but the older generation, they were like, that's awesome. That's amazing. That's a real human. The younger generation are like, what are you talking about? That's creepy. And if someone sends me that, I'm hitting block. That's just trying to reiterate your point. I think we're about to just get bombarded with this easy content where literally they were going, look, I can do a sales letter and now there's a human talking. It's like, if the whole world starts doing this, we're all in so much trouble.
Yeah. I think that's right. Like, I think like AI has that's the threat of it. Like, it's just like content overload, which is why I'm saying, like, I think we need creativity in how you like market and reach customers. I think the other side of AI is a huge opportunity for companies. Like every company that I'm working with right now, it's just like up and down the stack, how can we use AI to do things more efficiently? And like one example would be, I've got one portfolio company that they get like a ton of website, they get 100,000 website leads a month. And those website leads are pushed into do a trial of the product, a free trial. And then there's like an inside sales motion to kind of like convert those customers, especially like focus on mid-market, bigger ones. And they just like were getting all of these leads, and they just had their inside salespeople just like shooting fish in a barrel. Like it was just like no prioritization of which people to pick up the phone and call. They've just rolled out like an AI feature where like they use AI to effectively lead score. So based on these criteria, like actually like, and their behavior on the platform, like score these leads based on our customers, our existing customers, which ones would be the most likely to convert and be the best fit. And suddenly like they've increased their kind of growth rate from 4% to 7%, literally with that one change. And yeah, so like I think and that's just one example, but there's like huge opportunities outside of that, just looking along the internal stack of the go-to-market teams. But the other thing which I was triggered to say just by what you were saying is just the generational shift is the other big thing, right? I think like you were talking about like the elderly people were like, yes, this is awesome, this little LinkedIn widget. And then the younger people were just like, wait, what? I don't even use LinkedIn, I'm on TikTok. Like, and we are in the midst of a huge generational shift. Like, I think, what's the figure about like the generation coming up, Gen Z is now like 50% of the consumer and below. And so it's just like, they don't use the same go-to-market methods that you and I used when we were growing up. It's a new mode of reaching the customer. Like I've got pretty much all my consumer portfolio companies now have a TikTok strategy. I was like, I don't even know what a TikTok strategy is, but please educate me. And so, yeah, I think that's another big factor outside of AI is just the generational shift.
Hey, Tom, just to continue on the AI theme, really loved your article on the defensibility of AI and talking about moats. I'd just love to unpack that.
Yeah, sure thing. Yeah, look, I think I posted that article because I was trying to wrap my head around this kind of conversation going on in the broader market. And there's a lot of banter about GPT wrappers, and so you don't have defensibility. You're just like sitting on top of GPT-3, GPT-4. There's also this kind of conversation as well where I think like the tendency was to say, oh, okay, in order to not be a GPT wrapper, the way to build moat is you need to own the data. Data is the new oil, and you need to be the system of record. You need to own the data. And if you own the data, you can build the best models, and you have this privileged proprietary resource. The cornered resource is the moat. And I don't know, just like as I was like meeting with companies and reflecting on that, it just didn't feel right. Like I just felt like that wasn't the only source of moat. Like it is a source of moat, I completely would agree with, but it's not the only source of moat. And that just didn't sit right. And I think like what I was reflecting on was that as I was looking across a lot of companies, both in the portfolio and out, it's just like there's a lot of other moats which are emerging. And I categorize those moats at the application layer and the infrastructure layer. The application layer, it's this idea that like your product footprint can be a moat. And maybe it's just like a confusion around what an AI company is, but it's sort of like there's a lot of moat which you can build around building a beautiful product, the actual kind of product workflows outside of the AI features. And it's sort of like a question of like, what role is the AI in this product? Like, is this like an AI dominant product where like 90% of the user value comes from the AI itself? Like, and I might put into that category like something like a Jasper. And Jasper was one of those like marketing copy kind of things, popped up pre-ChatGPT. ChatGPT launched in November 2022, and Jasper was just blown out of the water. Like it was growing at an incredible fast clip, raised at $1.5 billion, and then was just blown out of the water when ChatGPT released. And I'd say the reason for that is because 90 to 100% of the value of Jasper was just in the AI kind of like chat feature. Whereas like maybe compare that to like a Canva, I'd say like AI features in Canva are very important, but Canva's a beautiful product outside of that. Like you can create presentations and Word documents and posters and collaborate with your team and share things and present things. And like, there's so much to the product outside of just like that AI feature, like text to image, an image for this presentation. And so maybe just like a framework to think about that is like, if AI was like 90 to 100% of the value for Jasper, maybe for Canva, it's 10% of the value. And there's all this other product surface area, which is providing a lot of value to the consumer as well. So that's sort of like one framework at the application layer. And then I'd say like the other kind of framework is at the infrastructure layer, and realizing that in order to kind of like get to your goal, which is just like, I want someone to use this AI feature and get the best output they can, like the answer, if you will, whether it's like, hey, like, can you help me write this blog post, or can you create me an image? Like you want to give that person the best blog post and the best image. Like that is the goal. And the reality is like the data or proprietary data is just one piece of the puzzle. There's all these other pieces of the puzzle, like how do you process that data, especially if it's like really complex unstructured data? How do you fine tune it? How do you orchestrate the models together to multiple models to achieve the best outcome? How do you manage costs and infrastructure? How do you evaluate model performance? Or how do you kind of like integrate customer interaction data or behavior data to actually interact with the output to even get a better output? And so the reality is that the companies that, in order to orchestrate on the best AI outputs, you need to get a lot of different things right. And so you can build moat, not just in the data inputs, but actually in all those other kind of features which are involved to get you to the best output. And yeah, that was like the source of that article.
In the article, you mentioned intercom, and it was Des Traynor in an episode just talked about that if you have to go and build all of the core functions of other bits to then leverage your AI, you're probably in trouble compared to the people that already have those core bits that can just add the AI. And
Right.
a lot of the startups that we've seen coming through, I think they've just created a mountain for them to try and climb that actually you're probably better off with a different business model to leverage your IP rather than trying to recreate like something that someone else has built already.
Yeah, no, that's exactly right. I think like that kind of falls into the bucket of like the application layer, right? Like Intercom has a really awesome platform for customer success or support teams to manage like customer support tickets. And you need this application which flows tickets and manages tickets and sets rules and permissions. And having the AI is like great, and really important to the success of customer support management. But at the end of the day, you still need a customer support platform. So I would agree with that. I think the meme got a lot of traction that you're talking about especially like when OpenAI launches like Sora, right? And it's like suddenly out of the blue, no one expecting it. They've just launched this like video AI model, and everyone's like, holy crap, okay, Runway and all of these other kind of products, like they just go to zero. Or they launched ChatGPT, oh my gosh, Jasper, Copy AI, like all these companies go to zero. And they don't go to zero, like they're still around and still plugging along, but it's just more like just to exaggerate. But I think the reality is like I was saying, it's just like, there will be situations where companies are threatened. And I think like for us, it's just, if you're building at the model layer, like you got some companies which might be building at the model layer, it can be really hard when you're looking, the reality is like, if your product is going to be a model like Runway, then you need to have a lot of data, need to have a lot of compute, and you need to have a lot of capital. And so you're like jumping into a ballpark where you're going head to head with like OpenAI and the capital and resources they have and the talent and all of these kind of other providers like Microsoft and here and just everyone who are like playing around in that. But if you're like building at the application layer, and so one other area that we're really interested right now is just like vertical SaaS. And the reason for that is just like, hey, like you can just like leverage models. And then if you can build really, really deeply into these verticals, like whether it's like lawyers or marketing agencies or doctors' clinics or whatever, like build product which makes you go really, really, really deep into those customers so that you're embedded in their workflows, but you're like integrating the AI off the shelf and you're not trying to like build or train your own models necessarily. You might be fine tuning them, but not building and training them. Then that is like a really effective strategy because you are building your moat at that product layer whilst just kind of like, and you kind of like de-risking, I guess, the model AI being a threat to you.
Yeah, I really like that article you published. That was pretty recent, I think, how AI is unlocking that vertical SaaS opportunity. And so one question I have is how are we pronouncing, is it SAIS, S-A-I-S? Like
that is a debate internally. I don't know the answer. But SAIS sounds great.
But do you see AI having an impact on the horizontal SaaS? Like will there be an impact there?
Well, like if I could just add in with safety culture, we're seeing a lot of deals that are actually going up against safety culture, but on a really vertical basis. So what was once a horizontal product is now getting forced vertical, it seems.
Yeah.
Yeah, that's interesting. Yeah, I think that's true. I think like horizontal product, like the way I'd say it is like horizontal was like the heyday of SaaS over the last sort of like 15 years or so, right? Like if you think about you got Slack and Zoom and safety culture and Intercom and all these companies, like they're horizontal. They're not vertical specific. They sit across companies. And if you just look at like what percentage of SaaS IPOs were horizontal versus vertical, heavily weighted to horizontal, I think 80%. And if you look at like the success of those horizontal companies, horizontal companies typically got a premium because they were thought to have like bigger market size, more potential. But most importantly, horizontal SaaS actually managed to crack, talking about product-led growth, they managed to crack that. Like, I think about Slack and Zoom, they all cracked like product-led growth. Vertical SaaS companies haven't been able to do that. And the reason for that is like, think about what it takes historically to sell a CRM to a doctor's clinic, or a lawyer's law firm. It's like, you're not going to be selling it on LinkedIn to an individual, then upsell, buy it with credit card. Like, it is like you're going in, you're doing a trial, customizations, integrations. Let's do like a pilot. Let's do something. It's like these big chunky ACVs, 12-month sales cycles. And so the biggest kind of difference between horizontal and vertical SaaS to date has been these guys, horizontal SaaS, cracked product-led growth, vertical SaaS hasn't. And what's funny with AI is that it is actually like unlocking product-led growth for vertical SaaS. And the reason for that is because you can now target an individual at those companies, like a law firm or a doctor and a lawyer and a doctor at those organizations. And you can say, hey, do you want like an AI co-pilot? And that is like a super valuable product to those individual users. And you're not trying to sell in like a product practice management solution or a CRM or this like organizational wide solution, which needs to be bought in by like 15 different decision makers. You're just going to a single person and saying, hey, this is going to save 50% of your admin today. Does that sound good to you? And they're like, yes. And then you can layer in the upsell to like the product management, practice management solution on top of that. So yeah, it's just like a really exciting time for vertical SaaS, because suddenly everything we love around go-to-market that's defined horizontal SaaS is now defining vertical SaaS, which is just opening that up as a market opportunity.
It was actually a portfolio company that we were using for a particular solution in the validation of our investors. But then someone came to us with actually, no, we'll solve every layer of what you're trying to do, which includes that layer we were getting from them. And so suddenly we were in an interesting position where we've actually got to leave a portco and go to a totally vertical solution, because this thing just ticked all of our boxes. It was marketed to us perfectly. It had all of our lingo. And that was just a big lesson of that verticalization. And it then ultimately helped the portco, because then they found their verticals that they're going to go and do the same thing for. Yeah. But people engage when they read or hear words that resonate with their story. And if you can perfectly put a message to say, I can solve all of these things for you, and I agree with you, starting small and then go wide, I think more and more that's going to defeat I've got something broad that you too can use it on these ways.
Yeah, well, I think like the reason we're going to see that happening more and more and more is also because like the ACVs of niche market opportunities have just massively grown with AI. So let me give you an example. Let's say, just take GitHub. Like GitHub has been around for a while, pre-AI, and GitHub's been a really valuable product for engineering teams to store their code and collaborate. Suddenly they roll out GitHub Copilot, and your average developer engineer out there today is getting 30% productivity gains using GitHub Copilot as a 2-year-old product. That's huge. And that's a fact. That's actually there's the head of the VP of engineering at the CTO at Commonwealth Bank actually came out in February and said, that's what we're getting 30% productivity gains with GitHub Copilot across the entire engineering function of CDA. So that's like that's actually tangible. That's what's happening. And so the reality is, if you're GitHub, you can now charge a lot more for your product, because you're providing so much more value than you were before. Now you're providing 30% productivity gains. Like, oh my gosh, put a value on that. Put a dollar value on 30% of the engineering function at CDA. That is a huge dollar amount of value that you could theoretically charge for. Now, when you create that more value, you grow the ACVs of customers, you expand market opportunities. And so you're seeing like this nicheification, if you will, of market opportunities, because the markets are bigger. So even like we're talking about law firms, like historically, like SaaS companies attacking law firms, you had to just go for the legal market, like the whole legal market. Hey, I'm a CRM for lawyers. Great. You're attacking all lawyers. And you had to, because the legal tech market is only so big, and the average law firm might pay 50 grand or something for their average CRM. It's just like, well, if you want to kind of like build a meaningful company, you need to go for the whole market. When you kind of like start rolling out AI and you achieve these huge value propositions, you can start charging a lot for it. Maybe you're charging sticker prices of 200, 500K for a law firm, not 50K. then you can actually go, oh, hang on a second, I could actually probably like start specializing in different types of law firms. And you see that, like we've got Even up in the US that just raised 50 million from Bessemer, and they are just building like an AI co-pilot effectively for workers' comp lawyers. Like that's it. That's how niche they're going. It's just like, it's incredible to see like companies going that niche and being able to build meaningful businesses in niches that small than we've ever seen before. So to your kind of point around that, like it's because of these expanding market opportunities and ACVs that are creating these opportunities for nicheification of products and services.
Tom, you're speaking our love language.
The riches are in the niches, baby.
Nicheification.
But it's so interesting. Like I never thought of that as I never thought of that as actually expanding the value, therefore increasing the price. Like when you first said GitHub, I actually would have thought adding a co-pilot would have expanded the TAM because more engineers like don't have to meet that threshold. They can actually use the platform because they have the co-pilot. But it's actually the other side of the equation. It's like we're expanding the TAM because we're increasing the average contract value because we're adding more value.
Yeah, and we're seeing it like if you look at the traditional SaaS products, like even like Zoom, like Slack, like you sign up for Zoom, $100, what like was it like $20-$40 a month or something, like $150 a year or something like that was the kind of sticker prices. Like with AI Copilot products, like we're seeing sticker prices that can get up to like $10,000-$15,000 a year. And it's just because like if you're solving 30 to 50% of someone's like daily workload, like they will pay you a lot of money for that. Like that's a huge uplift. If you solve that for me, I will pay you for that. And so like if you think about like just AI scribes for doctors, for example, like your average doctor comes home from work and then they sit down and they spend like 2 to 3 hours just typing up all the patient notes for the day. And now you've just got like speech to text, whip it up. Then you go text to like automated forms, like, oh, I actually have to like write a prescription form from this patient. Well, guess what? The AI just automatically created that prescription form exactly in the format you need, ready to go, just because like it interpreted your notes and automatically spat out exactly the outputs it needed to fill in that prescription form. And so suddenly like, oh my gosh, you just took me from spending 2 to 3 hours a day of doing crappy admin work down to like 10 minutes. Like I will pay you $12,000-$15,000 for that for sure. Like, let's go. So that's like where the opportunity is. And that's exciting.
And to your point in the 7 ways of getting moat, whether that becomes a durable business is going to depend on how well they get one of those, I guess, 7 buckets sorted.
Yeah. And I think that's where the durability comes in. Like if you were to say like, hey, isn't this just going to be like Jasper where like they're going to get blown out the water by OpenAI? Like, do I think OpenAI is going to go in and like learn like all of the specific prescription documentation of New South Wales and Victoria and USA and all the different states and like learn all of the doctor language that they use in different countries and medication forms? It's like, there's so much like unique fine tuning of the models of the AI, so much that unique product level. You need to integrate with like EHRs, like electronic health record systems. You need to like, be HIPAA compliant. Like, so there's so much to take like just like a generalized model to get it to what the output you want is like, just like in a doctor's hands, managing their workflows and giving them the best output they need. The gap from there to there is so wide versus like the gap from there to there for Jasper was quite narrow because you're just like a chatbot feature to spit out marketing copy.
I'm conscious for founders listening. We're talking about a lot of change and rate of change and outbound is dead and all of these types of things. And ultimately the companies that succeed will be those with the founders that succeed. I'm curious to switch the conversation more to that humanistic side of when you're looking at a new potential portfolio company making an investment. How are you looking at the founders? How are you assessing the founders and their capability? How do you get to know them? Because often we don't really get to see how a founder operates until you're in the trenches with them. I'm just curious how you approach it.
Yeah, there's something which a lot of VCs say, and it just frustrates me. Like you hear all these VCs say like, oh, like taking an investment or picking an investor, it's like getting married. And you got to like, you're in it for long. And guess what? It's worse than marriage because you can always divorce your wife, but guess what? You can't get an investor off your cap table. I hate that. It's just like, honestly, like I met my wife, like if I kind of like my marriage to my wife, if it was like a 2-week diligence period, met, IC pitch and like get married, like there's no way. Like this is my life partner you're talking about. I'm not approaching like investing in a company. Like I approach like selecting my life partner. So I hate that. But what I will say is I think the relationship's really important. And like, I think the best outcome for founders and investors is where the relationship is there and it's productive and you're supporting each other and there's honest and transparency in both ways. And we're providing value and you're asking for value and you're open to the value. We're providing feedback and you're open to the feedback and you're providing feedback. I love it when founders give me feedback and say, hey, you were really crap on that board meeting. Like, do better next time. So like, thank you. Tell me more. And so I think like that's really important. And so like, I think like trying to get a signal of that type of relationship early in the process, like, and it can be hard because these things move quickly, but I think like after you just do reps and reps and reps, you start to get a signal for what a good relationship can look like. I'd say like, we don't do psychometric kind of crazy psychometric tests of founders or anything like that, but you know, we do like ask questions. I think you can learn a lot about someone just by asking the right questions. And for us, I think it's a lot about like just trying to understand founder's life journey. Like we love like going into he's like, put aside the pitch deck, like put aside the business. I want to talk about you and your life and walk me through all the decisions you made in your life and those sliding door moments and why you made that decision or what challenges you faced and how you dealt with that. And I think you learn a lot about someone and the reality, like going on a founder journey is hard, it's gritty, it's going to be tough. And I think like seeing those moments in a founder's journey for where they've dealt with things that are tough can be really helpful to inform how they're going to fare with that. I think also just like delving into why they're doing this. We talk a lot at Blackbird about founders doing their life's work, and it's a great catch line, but I think at the heart of it, it just means like, you know, if you're going to found something, like it's really helpful to have a reason for founding it. Like if you've learned an insight, like, oh, I've been like working in this industry for 10 years and I've just like realized that, holy crap, look at this opportunity to solve it. And I just know this industry so well and I know the opportunity so clearly versus like maybe someone who's just like, hey, like I've spent 10 years at Google and I've just decided I'm going to go and try and solve the restaurant industry with this AI tool. And it's just like, well, I want to really understand why you picked this industry and what you know about it and what you understand about customers. And then I think also like oftentimes like the founders doing their life's work, it's sort of like it's the driver, it's the burning passion, it's the ambition, it's the hunger. It's like, hey, like I just care about this industry. I've been in it for 10 years. I want to go after. I think like the other thing I love looking at is just like, who are your first hires, or like who have you chosen as your co-founder? Who would be your first hires? And we love seeing founders who maybe have like that are magnets for talent and like, hey, like here's my first 5 hires. Like I've worked with them before. They're all just ready to quit and jump in. And that's like really compelling because it's just like, oh, like I can see that you've got a really good talent lined up and you're able to magnetize like good talent. And these are people who've worked with you before and they just want to do it again. Like, wow, that's really compelling. And I think like the other thing I'd say with founders, like I love is just like when they're able to reflect as much on the negatives as the positives. Like I think, you know, sometimes you have founders that come in and it's just like all roses and it's just like, hey, like this is going great and this is good and look at this and this and this. And it's just like, yeah, walk me through like what's going wrong, what mistakes have happened. Like, and I think the best founders can talk about the successes as much as they can reflect on the failures. And I think like just picking up on these things through the 2 to 3 weeks you might have in diligence and like asking the right questions and looking for the right things and behavioral patterns is probably if I was to just answer your question, like that's what I'd say. And then we do often references. I think when you've got 130 portfolio companies and hundreds of founders and a really rich community, you start to get to a point where there's a lot of touch points between people in the community. And so oftentimes when a founder's coming in, we can either reference like where they've worked before or people they've worked with, and that could be really valuable too. And we don't put a ton of weight on that. Like we care about that, but at the end of the day, we want to make our own decisions, but that's an input.
We were probably a little naive early in our journey when we say, oh, great market, great product, good traction. But actually there's a few issues here in the team, but yeah, we're ex-operators. We'll be able to help them and fix all these things. But what we've learned that you've just got to be so confident that the team have got it. And at best you can provide some influence and support. But I think one of the most difficult parts of this job is when you like everything else, but actually you just form a view that the team don't have it. And that's highly judgmental and difficult. And it's hard to have that conversation, but the reality, success leaves clues and failure leaves all sorts of lessons. And this game has that aspect that's just difficult.
Yeah, it's really true. I think like that challenge compounds the earlier you invest, right? I think 75% of the companies we invest in are pre-revenue. So you got nothing to go by really, except for like an idea on a pitch deck and a founder sitting before you. There's no traction to look at or customers necessarily to talk to. It's so like at the end of the day, it comes down to the founder. And when you're investing this early in companies, like things change so rapidly. Like the vast majority of companies 1 year later look so different to when they pitched you 1 year before. Like it might even be in a completely different vertical. Like I was doing like NFTs and now I'm an AI company. It's like, okay. And the reality is like, so you can look as much as you want at the market opportunity or the idea and dissect the business, and that's great. But at the end of the day, like this founder is going to pivot this business like 100 times over, and they've got to be smart enough to recognize the need to pivot and smart enough to execute on the pivot. And you just need someone who's going to learn it all and move and execute and magnetize talent and build a company. And because this thing's just going to iterate and iterate. And that's why it's so important to get the founder dynamic right.
There's a rumor in the market that despite thousands of cold inbound pitches, Blackbird hasn't actually invested in a cold inbound. Is that true? And if so, is that part of this, what you're describing now?
That's definitely not true. And I'm actually really weirded out by you saying that's a rumor. I might actually have to follow up with you on that just to understand like how deep that is a rumor. It's really odd. But yeah, couldn't really be further from the truth. Just to put it in like, we just wired capital last week to a company that came in through website cold inbound, and we've got a pitch this week that's going on that was cold inbound from the website as well. So that's like the here and the now. And then like if I went through and dissected all the history of investments, there's been plenty of cold inbound too. Like it's interesting just to take a step back because we talked about like my background, and I came into VC from a go-to-market sales sort of background, like operating background, 8 years like in the trenches of sales. And I fundamentally view, and this dovetails into your question, like I view VC as a sales operation. Like Blackbird is a business. We are a capital provider to startups. We have customers who are founders, and just like any other business that we invest in and a portfolio companies, we have a go-to-market strategy for us as a business to secure our customers are founders. And our go-to-market strategy is inbound and outbound. And we think about product-led growth, and that's why we launch things like Giants. Like this is a product that is like literally driving the growth of Blackbird as a business. And the reality is like inbound, as with any company I invest in, is 100 times better than outbound. Like inbound, like leads, as in founders reaching out to you, that's happening because you built a brand. That's happening because you're writing content like my articles. And that is so much better than outbound, because as with companies, any company that's 100% reliant on outbound, that's expensive. That's hard to execute on, versus like everybody wants inbound leads. And so, but the reality is like, as much as we love inbound, we also do outbound. Like we invest a ton in outbound. We're trying to like outbound founders before they even think to inbound us. Like we do a lot of like just going out there and identifying awesome operators in the community who might have not even thought about doing a startup and getting in touch with them. We launch programs like Giants and Foundry, which is like, hey, like come and incubate an idea that you have before you even got a startup. And we do that because of, like I said, product-led growth mentality, but also that's a way for us to build these relationships with founders before they've even got a startup, and get in early and make sure that like we're increasing the surface area that we have for identifying companies and meeting them. And if you look at these kind of programs that we do, like Giants and Foundry and Sunrise, where the goal is to just make sure that we're like got as many touch points with potential founders or actual founders in the community, like we invest a lot in them and they're successful. Like Giants, like I can name 5 companies that we've invested in that came through Giants. Foundry, we've had a bunch come through Foundry. Like Sunrise, Nikki just did an investment in a company that was via a cold meeting that happened at the Sunrise conference. So there's a ton of that. And then even outside of that, inbound, LinkedIn, Twitter, I respond to everything. It comes in. So that's like the framework I'd say. Like it's about inbound, outbound. We invest a ton in it. We think about it a lot. We think about it like any kind of go-to-market engine of a portfolio company. We think about product-led growth. And that's why we do things like Giants and Foundry and Sunrise. These are products for us. And then I'd say at the end of the day, like the other thing that we really think about a lot on this topic is just like, our network is really big now and it's just compounding. We now have 130 portfolio companies. Like 10 years ago, we had 20. And when you have 130 portfolio companies and hundreds of founders, like the reality is there is a lot more inbound, and referrals are coming in at a much greater rate than they would have in the past. And so the ecosystem's broad and our network is deep, and we try to kind of like create as many touch points as we can for folks to get into our network. And we actually, funnily enough, just talking as well as about like how like companies operate with their go-to-market, thinking about Blackbird having a go-to-market strategy and inbound and outbound, we actually have a go-to-market OKR too. And our OKR at Blackbird, which we track every single month and report on, we call it our see all the seeds tracker. And basically like every investment that happens in our ecosystem, in our mandate, whether it's like a pre-seed or a seed round, we track every single deal that happens. And we then rank it as like, did we see this? Did we see and pass on it? Did we invest in it? And we track it. And our kind of key OKR as an investment team is to make sure that we see all the seeds. Like, so if we're like only seeing 50% of the seed and pre-seed rounds happening, we're failing. Like our OKR is to be up above 80%. And so we actually track that. And so our job, like if we're not responding to an inbound lead and a deal happens there, then we're actually getting pinged on our OKR. So we're incentivized as a team to make sure we meet with every deal. We have to see all the deals that are happening, all the companies out there, make sure we're seeing them, and we track like time to respond, and we track founder NPS and all these other factors too. But that's like really, really important to us. So I guess
I absolutely love that.
We love inbound. Please inbound me as much as you want.
It was probably a corporate advisor who was pitching to say, oh, no, you need to engage a corporate advisor because it's warm intros that get you money. Yeah. It's probably some rubbish like that.
Yeah, I mean, like there's a lot of confusion in the market. Like a lot of people get confused about Blackbird and who we are. And I think there's a lot of players in the market and they've all got their own interests and trying to create their own stories around who we are or who they are. I think like the other kind of big misnomer out there, like, okay, so Blackbird doesn't respond to inbound leads. Like that's just ridiculous. Like that's just kind of like debunk that. The other big one is like Blackbird doesn't go early. That's another one. And it's just like, well, no, that's not true. Like just because we've raised bigger funds, like we've got $1 billion fund, and we used to have like a $29 million fund back in the day for fund one, but now it's $1 billion. That doesn't mean like we're suddenly only doing 50 million checks. Like look at my last deals. Like I did a 25K check. I did a 100K check. Like we do small angel checks. We do big checks. We split our funds into like a very large later stage fund, which is just focused on like Series B plus. And then we have like a seed pre-seed fund. And my job with the pre-seed seed fund is to be out there doing these pre-seed seed checks, and we go early. Like 80% of our deals are pre-revenue, and so like that's like a misnomer which is floating around the community as well. So yeah, I mean like everyone, these perceptions about Blackbird, and we just got to make sure we're like being honest to who we are and what we do, and just roll with that.
Jack?
Oh, I was just gonna say, like we take a lot of inspiration from you guys. So like from another VC's point of view, we're obviously a very different stage to you guys, but like we love everything you guys put out, and we really take a lot of inspiration.
Thank you. I really appreciate that. That's really nice feedback. Yeah, I'd love to take credit for it, but you know, the reality is I'm just one small piece to the Blackbird puzzle. I tie it back as well. Like I love this ecosystem. Like I mentioned right at the start, like I'm really patriotic about Australia. Like that was a big driver behind coming home, and I just love being here. And part of my framework is like, yes, I've got a fund here. I want to drive returns for my LPs and invest well and build meaningful returns. But the other part of it is I'm just pumped to be part of an ecosystem that I care about, that's growing. And there's so many awesome ecosystem operators here. There's founders, there's other VCs, there's service providers, and we're all here. We're all trying to grow this ecosystem. And I've got this mentality of like tide rises, all boats float. And I also have this other mentality of like village investing. Like I love just like these early stage rounds, like often come together and you've got co-investors and co-leads and angels like coming in, and it's just like, yep, let's do this. Like build a village around this founder. That's just going to increase the success rate of this as a company, like more hands on deck. And so, yeah, look, I just love that. Moral of the story being like, I appreciate the feedback, but also just like to say, I love this ecosystem and love everyone in it. And I think it's just like a really collaborative ecosystem where we can all work together to just like drive a better outcome for everyone.
It's one of those things when you develop a brand, the ecosystem takes on its own view of things. So it's great for people to realize that actually, no, you haven't become too big for your boots. You're here to help even at small levels. Yeah,
I don't think I've actually got pretty small feet, so I'm not big for anyone's boots. But yeah,
no. I think with as the size of funds go up, and when people see some of the check sizes reported, but like you say, behind the scenes, in order to do pre-seed and seed, you have to be playing in that manner, and you are. So that's awesome.
The fact that you also covered the business of VC and that transparency that even Blackbird has to focus on these core metrics and driving business and driving engagement and driving growth. I think it's something that's often forgotten in the ecosystem. You look at the success of Blackbird and assume it's almost all this automated magic, but the reality is it's good people like yourself actually driving all of this.
Yeah, no, I agree with that. I think like one thing I'd say about that is just like, I find it funny. Like, I think like the trick with that is just to kind of like reflect on every piece of advice you ever gave a founder on a board meeting, and then look in the mirror about that being advice that you should take for Blackbird. So like the example I'd give is like talking to founders about like, hey, like the culture of your company, like talking to you about engagement scores. It's just like, hang on a second. We need to reflect on the culture of Blackbird. Like, how are we doing as a team? We got 60 people now. Like, come on, like, let's reflect on that. Or like, you sit there on a board meeting and you're like, what's your AI strategy? Like, every startup's got to have an AI strategy. Like, I'm hammering the door on one startup. Like, come on, we got to like build our AI strategy. And I'm like, hang on a second, we need an AI strategy at Blackbird. Like, there's so many, and we've actually done that, and we've actually started rolling out AI tooling internally for different, like, hey, like we've got like an AI network navigator kind of tool, and these sorts of things. And so I just think, like, to your kind of point about VC as a business, it is a business, and my push would be like every piece of advice you give to any other business, i.e. portfolio company, like turn it on yourself and then like think about that from your perspective as your own business. So
we had a Blackbird associate reach out, touching base, this last year, and just saying, are there any deals that you guys have got going in this area? And we as a team went, isn't it awesome? Someone the size of Blackbird has still got people out in Blackbird creating relationships, looking for deals. Like, there's no resting on laurels. They're clearly going, all right, well, we'll just sit back here. This person was fossicking for work and hustling, and we thought that was awesome.
I mean, the old adage is like, you're only as good as your next deal, right? And like, I just think, yeah, complacency is going to be the death of any fund. And so it's always about the next deal. And that's all I think about, to be honest. Like, I love my portfolio companies, and I would live and die for them. And sometimes that's a problem. Like, I get too attached emotionally to their success, and inevitably failure is part of the model. But yeah, I'd say I'm always thinking about the next deal, and there is a hunger across the team just to make sure that we see that. And that's why we have See All the Seeds as an OKR, and just trying to make sure we're part of it.
No, it's great. Well, thank you so much for your time today, Tom. Been an awesome episode. I look forward to getting this out.
Yeah, it's been awesome, Tom. I really appreciate the time. Thank you.
Cheers, Tom.
Yeah.
He's good.
Good.
Really good.
Fuck, he's smart. I love that.
Yeah.
I love the mentality of Blackbird.
Yeah.
What was it? See all the deals?
Yeah, see all the deals. And I think the Blackbird brand sort of has taken on a world of its own.
Yeah.
But behind it, there are just good people. Yeah.
Yeah.
As you heard in that episode, just giving it a red hot crack. Now, they'll have some advantages over people like us in terms of brand and deal flow and just that whole network. But that's our role, to build and create something similar.
Yep. He's awesome.
I was just going to say, interesting about the whole AI, like the penny drop, the example he gave about, I think it's called Heidi Health, which is like the scribe for doctors. So even if we assume OpenAI will never go that deep and offer all that same stuff for doctors, but if someone else enters the market, then the margins has to be squeezed unless there's some sort of defensibility.
Yeah.
But yeah, I just never thought of it like that. We could see contracts triple just because the value they're giving.
But the thing, and I'm going to go back to his articles and then have a look at some of the stuff that we've put together. In my mind, it's the defensibility. Like right now, absolutely. Yeah. But it's like the cure for high prices is high prices, that if there is this big margin, you better believe there's a shitload of capital that's going to come to the space. And so what is that defensibility against people also going, okay, you're charging 15, so I'll charge 14. Okay, yeah. I'll charge 13. And before you know it, you've got the airline industry, a commodity product subject to competition. The marginal profit always goes to zero. So what's going to stop these people becoming a commodity product? Where's the stickiness, the network effects, whatever it might be? So that's the bit that we're going to work out. I'm going to be fascinated to see how safety culture evolves over the next 2 years.
Yeah, same.
Every pattern we're seeing is that they're going to have to start getting some really hardcore vertical solutions to add to their horizontal solution.
Yeah. I'm glad you clarified my horizontal question. But yeah, like all of those, like how will that play out?
Yeah, the thing for them, they've got that much amount, like they've got so much resources, they've got scale, so they could just choose the biggest verticals and own them.
Yeah. And still have an amazing global business.
And it could actually evolve from not just being a checklist, it could evolve to being the CRM for the vertical.
Yeah. So because the example he gave there for doctors, but if you look at our example, we had, let's say that there are 10 processes in our stack. One of them was KYC. Then someone came along and said, we'll take 9 of your processes in your stack, including KYC. It was a no-brainer. So we jumped. So it was that vertical solution. So then taking that into the doctors, I think the Trojan horse approach is, here's a little AI co-pilot that deals with one part of the stack potentially, but then you're still going to have to very quickly have the other parts of your process stack to create that durability, to create that lock-in, aren't you?
Yeah, on my view, it sounds like Tom really liked PLG companies. That was my view. And he's hunting for them because the AI company for the doctors, that's just a AI tool for an individual doctor. So it's bottom up, you go straight into a vertical. It sounds like he doesn't like the bigger CRMs where it's a slower sales cycle, even though they can be great businesses and defensible. They just can't grow like a weed that have that virality bottom up approach.
All right.
Cool. That was good.
Good episode.